The argument against ultra-low interest rate tends to be reduced inflation and asset price bubbles. Joining me down the line to discuss how the Canadian economy is coping with this situation is Emanuella Enenajor from CIBC World Markets. Now, Canada's all items consumer price index in March climbed 1% year over year, below the previous month's 1.2% reading and market expectations for a 1.1% advance. How would you describe the country's economic stance 1 month on, and what are you expecting from April's reading?
Well, 1 month on, we don't really want to look at month-to-month changes in the economy because you're picking up a lot of noise. But just in terms of the economic trends, we have been seeing signs that, after a strong start to the year in Canada, the economy might be slowing a bit. And some of that has to do with weaker momentum from the U.S. Some of that has to do with some temporary boost to the economy in the resource sector fading as we go into the spring and into the summer. And so there is the risk that the Canadian economy could slow down. And it's really that slower pace of growth, that sub-potential pace of growth that's keeping a lid on inflationary pressures.
Some analysts say that one of the possible consequences of the Bank of Canada's benchmark interest rate of 1% is that it is allowing provincial finance ministers to avoid getting serious about their strained finances and floating weak companies that would otherwise go under. Do you think this is the case?
I think that what the Bank of Canada has done through the crisis and through the recovery is it's really tried to set interest rates at a level that would get it to meet its ultimate goal, which is inflation at around 2%. And, the Bank of Canada was actually one of the more hawkish central banks in the G7 and across the world, raising rates first, while some other economies had kept their interest rates at low stimulative levels. With an inflation rate of around 1%, that is reason to continue to support the economy with low rates. And the bank has, it has continued to point to the fact that eventually rates will be going up. So they've been giving not only households, but various agents in the economy, ample of warning that, hey, these low rates aren't going to be low forever. There is the possibility that when things pick up, they're going to be moving up higher. And so from that perspective, I think the bank has really been maintaining that independence and that focus on keeping rates targeted towards its key goal, which is inflation.
You mentioned inflation is a main target in light of the sluggish growth. There has been the suggestion that the Bank of Canada should start now to reverse some of its monetary stimulus and begin raising interest rates. But what do you think?
Definitely, the bank doesn't want to jump the gun on raising rates, particularly when the economy is experiencing its own sort of organic slowdown. And we have consumers that have for a long time been piling on debt through a growth in mortgages and credit card debt. We're seeing an organic slowdown there. To some extent, it's a slowdown that's been triggered, at least in the mortgage market, by new regulations that the government has been putting in to slow the mortgage market down in Canada. And that's been affecting home building, that's been affecting consumer appetites. And so, there's no need, I think, given that you're seeing that slowdown already happening, for the Bank of Canada to attempt to, put the brakes again on the economy. And so I think that's one of the reasons why the bank had initially been looking like the bank was going to raise rates sooner. But given the slowdown that has appeared in the economy, the bank sort of backed away from its aggressive tightening bias and just sort of said, well, eventually rates are going to be going up. So they say they indeed are not trying to choke off, if you will, that recovery, just keeping rates stimulative enough to support growth without creating any potential, if you will, excesses in some of the markets that appear to be that initially had appeared to be in a very high growth phase.
So this sluggish growth is keeping a lid on inflation. Higher interest rates quite likely would put upward pressure on the currency, which is already trading at a level which the Bank of Canada says is hurting the Canadian competitiveness. But some experts believe exporters could handle a modest appreciation because the steady recovery of the US economy promises steadily stronger demand. Do you agree?
I think it depends on why it is the Canadian dollar would appreciate. I think if the Canadian dollar appreciates because foreign investors, for example, suddenly decide they want to hold Canadian government securities, and that pushes up the value of the Canadian dollar, that's not really an appreciation that the economy can tolerate, because it's not an appreciation that's triggered by underlying fundamental economic strength. If, however, the Canadian dollar appreciates because oil prices are rising, because the U.S. economy is showing signs of strength, and that's having an impact on the valuation of the currency, then you have an offsetting positive factor that's helping to mitigate some of the the harm to the economy done by a currency that's rising. So it really has to do with what the driver of a higher currency is. And, thus far in the last couple of years, we've been seeing a tremendous inflow foreign interest in Canadian dollar-denominated bonds, Canadian-denominated assets, Canadian dollar-denominated assets, and that has caused Canada's trade account to be in deficit. And so it's sort of the wrong kind of demand for the currency. It's the wrong kind of factors that have been pushing the currency up over the last couple of years. And that's really what's been hurting Canada's economy as far as the trade side goes.
You touched already on the housing market, but as we enter Q2, what are the biggest economic hurdles Canada is going to have to negotiate, would you say?
The biggest sort of drags on the Canadian economy ahead, I would say, are twofold. Firstly, you have the ongoing slowdown in the housing sector. And this isn't sort of this is a I would call it an engineered slowdown. So it's a slowdown that in large part was sort of pushed along, if you will, by some regulatory changes made to slow down some of the excesses in the housing sector. So we're seeing that slowdown unfold, and it is weighing on growth. It's a headwind to growth, and it is having an impact, again, in secondary ripple effects on consumer spending, to some extent consumer confidence, and home building. And so that is one factor that's going to be a drag on growth. And also for Canada, we're seeing reductions in government spending in real terms as governments are continuing to pare back deficits and to reduce spending. And so that's another factor that's weighing on growth this year and likely will continue to weigh on growth in 2014. Offsetting that, looking ahead, we're looking for better signs of growth for the U.S. come 2014, and that should be a positive for the Canadian economy. So it's really a tale of sort of two conflicting factors for the Canadian economy: weaker domestic growth. However, looking forward, the potential that as the global economy heals, the Canadian economy will see some of the benefits from that.
Taking everything that we have discussed into consideration, what is your outlook for the CAD moving forward?
Well, over the next 6 months, the Canadian dollar will likely be affected by some of the concerns that we're seeing globally right now. So there's some talk that potentially China would be lowering its growth target, or that Chinese growth has been slowing for some time and will likely slow this year further. You're seeing an ongoing weakness in the Eurozone with the recession there. And all of these factors are potentially weighing on energy prices and weighing on global commodity prices. And given the correlation with the Canadian dollar, that's putting some downward pressure on the dollar. So we're actually looking for the currency to continue to lose a bit of ground, potentially, sinking to a couple cents weaker than parity further than where we are now, before we see a bit of an uptick. And that could really wait until 2014.
Emanuella, thank you very much. Well, that's all from me at the moment, but click back to Dukascopy TV for today's press review focusing on Turkey with my colleague Natalie MacDonald. Goodbye for now.